All right, guys, it's 11:02, so we're going to go ahead and get started with today's session. Today, we're just going to go over just best practices for underwriting apartment syndication deal. This is actually part three. We did two previous parts before. I think Charles did one and Sean also did one. So, as you know, we're in the multifamily syndication business, and underwriting is a huge part of deal analysis. So, we want to make sure we kind of have a good handle on that. So we're just going over some basics that's important. So the whole essence of underwriting is just to, as you know, gather financial information about a property, rent roll T12 OM, where you can use that to help you to make an analysis. The ultimate thing you want to get to is getting a value or a price to assign to that property, where you can make sure it makes sense for you and your investors, right? So that's definitely what you want to get to. You should have some metrics in mind in terms of what you're trying to meet in terms of cash and cash return, whether it's average annual return or whatever metric that you are using. So make sure that you have those in mind, and when you underwrite a deal, if it meet and exceed those metrics, then certainly you want to consider that deal more closely. So we're going to delve into that just a little bit today in terms from the numbers standpoint, just to work with the T12 and the analyzer that you choose to use. So we'll cover underwriting, what it is in terms of multifamily. You talk about the models. We'll talk about the income and expense category. That's primarily what we'll focus on today, and just input in the data from the T12 into the model. Underwriting, normally takes some time, so we'll kind of give it in different segments here so that you can, get bit and pieces of it so that it's digestible, right? Don't want to overwhelm our audience at one time. So just a little bit about me and my role here in Cash Flow Champs. My name is Paul Senior. I'm one of the managing partner with Cash Flow Champs, and I live in Prince George's County, Maryland. And just some more information about our team, you can simply go to cashflowchamps.com and hover over the About Us button, and then you will see information about all the partners there and what we have been doing. Myself personally, been in the multifamily space for about 4 years or so, coming out of the single family space. Was in that space for about 15, 16 years, and joined up with these great guys, and we formed Cash Flow Champs, and we have taken off now for about a little over a year. I'm co-host with the Cash Flow Champs Real Estate Podcast. Prashant Kumar and myself, we do that, and we have a portfolio now of a little over 1,900 doors. So we continue to grow. We primarily are in the southeast part of the United States, Florida, Georgia, northern South Carolina. Those are probably where our footprints are mostly. Have little assets, different part of the country, but those are where the bulk of it is. We do offer a help to the public in general. So we invite you to learn and partner with us. And, you can attend our underwriting sessions. We have one by Charles Seaman every Saturday. And to get there, you can just, scan the QR code in the middle of the screen there and try to go to that. We also encourage you to schedule a call with us if you want to learn more about us and our team. We invite you to do that. And certainly we'll chat with you and see if there's any synergy there, any alignment of interest. We're always open to, give opportunities to individuals as well. And last but not least is our coaching program. We do have a coaching program active right now. Some of our students are taking down deal with us. We closed in a 236 unit deal earlier on this year in the Atlanta MSA. Great asset right outside of the airport. And some of our students join us on that. So one of the promises that we give our students is that once you stay with us, you will eventually close a deal with us. And so we offer that as well. I'm not an attorney, financial advisor, or tax advisor, an accountant. The purpose of this webinar here today is just for informational purposes. So if you need tax advice or some financial advice, you want to seek the appropriate personnel to get that done. Okay. So again, in today's session, we're just going to kind of cover some underwriting. Again, we say underwriting is just the process of just gathering financial information and data on a particular property so that you can make an analysis of the property to see the viability of the property, if it meets the metric and criteria that you and your investors are looking for in terms of in terms of making a deal feasible for you. So here is the model that we'll use. This is called the SDA, the Syndicated Deal Analyzer, and this one is by Michael Blank. And you know, there are different underwriting tools out there. So by no stretch of the imagination, this is the only tool. This is the one that our team tend to use most frequently, but different guys have different tools out there. And so you can, you know, can seek those out and see which one works best for you. You know, I would say just get comfortable with the tool. You don't have to use them all. Just get with an underwriting model that works best for you. Make sure you're comfortable with it. And once you pick one, I would just say pick it and stick with that one, because that way you kind of get to learn the in and out of that model and you can work with it very efficiently. Some people also create their own model, right? If you're very good at Excel, you can also create your own model. Certainly, you can do that and share it with the general public as well. Of course, if you create your own model, then you'll definitely know the formulas and things like that you'll put in there. So that's probably the best way of going about it. But since I'm not great at Excel, I'm just kind of average at it. I want to go ahead and use the SDA. So what we're going to do is just go through this real quickly in terms of how to underwrite a deal, how to get information from your T12 into this model. And we just have 30 minutes to go at it at this point. It's 25 minutes. So certainly we're kind of speed it up a little bit. But if you ever have questions, just, you know, let me know and we'll address those either here or even after the session, right? So you have the acquisition section of this model here that states your purchase price, your number of units, your down payment, your interest. If you have interest only on the loan, some loan you can get interest only a set portion of it. For example, a lot of the agency that, you know, you can get 24, maybe 36 months of interest only on it. You want to make sure that you calculate that inside of your model when you are doing that. The loan balance that's currently on it, if you're assuming a loan, there's a lot of assumptions that are going on right now in the space. People who purchase properties, you know, a couple of years ago where interest rates were great, you can assume those loans. Those are normally Fannie Mae, you know, Freddie Mac loans. You can assume those loans, and there's a balance there. That's where you'd put that in there. Your repairs, you know, it's more like your CapEx repairs. Normally, when you pick up some of these multifamily properties, you will have some type of repair to be done to it. So that's normally where your CapEx goes. So you can, for the number of units that you're gonna renovate, you know, pick up a 100-unit property. You know, the seller may have already renovated 50% of it. You may want to get in there and do the other 50 or a portion of it. Then you go in here, and this is where you put the number to represent how much you're going to invest in terms of each unit. Plus, also you can put in exterior repairs there. So, you know, for example, if you were going to renovate 50 units on a property, and say you're going to spend like you know, 15,000 per unit, then you just put the 15,000 in there times the 50 units that you're going to renovate, right? And if you're going to do some exterior work to it, so you're going to put another 500,000 exterior capex work into the property, you know, doing the siding, doing the parking lot, whatever you want to do, maybe roof, whatever, then that's kind of how you go about that. So you'd stick your number in there. So you'll see that some things are in blue right here. Some of the numbers are in blue and some are in black, right? You can see when I click on the one in black, there's a formula in there. So each of the ones that are in black do have formulas in there. So you may not want to touch those unless you're very good with Excel, because what happened when you change something on the screen here, it replicates through to the other sheets, okay? So just make sure that you don't necessarily touch those if you don't want to have to. The ones are in blue are the one typically that you change in this model, so to speak. Another area is the income area, right? So we have the acquisition area, we have the income area in this model, and similar here, you have blue and you have black columns. So I want in blue, you go ahead and change those. And for example, your gross potential rent, you can change that. So in the income column, you have the gross potential rent, the vacancy, concession, loss to lease, bad debt, and you have other income as well, right? So that's what's comprised the income section. So if you were to look at your T12, this is an example of a T12. Again, when you are working with a real estate broker, you see a property that you like, the broker will have financials on the property. This is one of the piece of the financials, right, which is your T12. Your T12, T represents trailing. So it's pretty much saying trailing 12 or the last 12 months of financial data that's pertaining to this property. So the T12 is one of those documents or financial data that you will receive from the real estate broker. Typically, you get your T12, you'll get your rent roll, and you will get your OM, which is your offer memorandum, right? So you can get other information on the property as well about the taxes. You know, you probably, if you're dealing with a big team, you may get information on a debt quote and just different things regarding the property. But certainly those three are your basic ones, right? So what we looked at earlier was the income category on the SDA, syndicated deal analyzer. So if you look here on the screen where it says revenue all the way down, before you get to expenses, the end of the revenue is a total revenue here. Everything that's within that highlighted area will fall into your income category, right? So your gross potential rent will be in here. Your physical vacancy will be in here. A concession, loss to lease, bad debt, which is part of your what we call economic vacancy, will be in here. And of course, your other income will also be in here. So everything that's highlighted here in the revenue section will fall under one of the rows in the income category right here, right? If we scroll down to the expenses, then you can see the expenses have their own line items, which are advertising, contract services, gas and electric, general admin, insurance, legal, real estate taxes, trash removal, management fee, payroll, repair and maintenance, turnover, and water sewer, right? So those are the category in the SDA as it pertains to the expense column. And so what happens then is that everything that's under the expenses in your T12, which is pretty much from line 46 all the way down to the bottom of it, all of these will fall into one of those categories on the SDA, right? So everything here, each line item must be accounted for, and it will fit into one of those categories. The important, now, different people is all, you know, is a matter of opinion for a lot of them, a lot of these line items, right? Something that you may call repair and maintenance, I may call it turnover, right? But the important thing is that each line item goes into one of those categories in the SDA. Leave nothing out, right? Make sure it's captured all here. So that way it is accounted for. Now, in the multifamily space, when you're underwriting a deal, you have what's called operating expenses. You have non-operating expenses, right? You have operating income and non-operating income, right? So it's very important that you have an idea which one is operating income and operating expenses, because in the income category and in the expense category, those are the categories that we account for, right? So non-operating income, non-operating expenses mostly will fall outside of that, right? So for example, if you do a roof in terms of repairs, that's not an operating expense, right? In the sense that may happen probably once every 10 or 15 years. It does not happen every day on an operational basis to make the property functional. So you would not account for that type of an expense in this expense category here. That's what we'd call a below the line item, meaning that it is not necessarily underwritten here in determine your NOI. So the NOI, net operating income, is kind of what dictates the valuation of the property, that and what's called your cap rate, right? So bottom line is that you're trying to find out what your NOI is on the property so that you can get an overall evaluation of the property. And we do not account for non-operating expenses in that category. So let's just take a quick look here in terms of what we have in terms of this T12, and let's just transfer this data over real quick, and then you can get a feel for how you would do that going forward. Now, underwriting is something that you want to practice pretty frequently. If you're going to be in the field as, I don't know, most of you here are probably limited partners in terms of getting into deals. There may be some people who are interested in being general partners as well, but whether or not you're a general partner or you are a limited partner, it is important for you to at least have a basic idea and understanding about underwriting. And that's why Cash Flow Champs is bringing this to you, because we feel that an educated investor is the best investor, because you can make informed decision, right? And so that's the whole essence of this. So even if you are a limited partner, you should at least have some idea, ballpark, in terms of, how are these deals analyzed? How are these deals evaluated? Does this deal at least make sense? Or at least you can ask educated questions about, an operator and how they've kind of come to their numbers, right? So again, this is a T12. We know that by now. And what we normally do when we're underwriting these deals, we first and foremost want to make sure that we have 12 months worth of data, right? So you want to make sure you have 12 months worth of data here. And if you don't have 12 months worth of data, then you do have to annualize that data, right? You have to account for it in that. If you only have, say, 9 months, for example, you want to go through, divide those numbers by 9, and then multiply by 12 so that it's analyzed, right? So, we can touch on that more later, but the important thing is that just know that you should always be working with 12 months worth of data in terms of your income and your expense data. Otherwise, your numbers can be real skewed. Then throw off your numbers significantly. There are different type of accounting when it comes to T12. In this one, you can see accrual accounting, right? You also have cash accounting as well. And you have to know the difference between the two. And you have to, do your underwriting based on what you have there. In this case, we have an accrual accounting. And because of that, with the accrual accounting, one way of indicating if it's an accrual accounting is to look at, this is normally your gross potential rent line. The first line is normally your market rent. Some people call it gross potential rent. But if you look at these numbers, they're pretty consistent, right? Going through very slight changes as you go along, right? So that's a good indication of accrual accounting. These numbers here are normally set by your property manager or it's set by your seller, right? In a cash accounting basis, then these numbers tend to fluctuate much more because they're indicative of the actual rent that has come in for that particular month. And people pay rent at different times, and so it can fluctuate greatly. With underwriting a deal, what we normally do is to use the last 3 months of the on the income side, right? So in this case, we'll be looking at actually K, L, and N column, the K, L, and M columns, right? And so we normally use 3 months in the income category for a variety of reasons. One is that you want to use the most latest data in the T12 that you have. Secondly, is that income line items are typically more consistent than expense line items. Some expenses you probably pay once or twice a year, right? For example, your insurance or maybe your taxes, real estate taxes. You may pay those once or twice a year. So if it is that you pay something, say, in June for your real estate taxes, you pay all the real estate taxes in June, and then you're using a T3 analyzed basis, that means you would not capture the payment in June. And your taxes are normally one of the biggest line item in terms of expenses. And so if you miss that, then your numbers can be very skewed as well. So in this category for income, this is normally your T3 annualized, right? So we should just call it T3 annualized. So that's the column we're going to deal with. So here, simply what you do, we just go there and find the summation of that. And then we're dealing with column K, L, and M. So what you do, you stick it in here. And that represents 3 months worth of data, right? So we say in order to capture the whole thing, then we have to annualize it. Of course, to annualize 3 months, we multiply it by 4 to get the full 12 months. And that is now the data that we'll be working with on a T3 basis versus the yearly basis. When you do something like that, it's very important that you kind of take a look at the trend that is going on. You can see on an annualized basis, we have 2.99 million there in terms of the total income, gross potential rent for that year. So again, if you would calculate these numbers from here, all the way back to here, if you look at the bottom of the screen, then you'll see it's 2.999625, which is indicative of what's exactly here, right? So on a yearly basis, that's what would come in. On a T3 basis, you can see the number is a little bit elevated, right? It looked like we have roughly about $126,000 more in terms of gross potential rent. So what that's saying to you is that this is a good thing, right? So in other words, as the property goes along for the year, it looks like we're getting more rent in the latter part of the year. And that's the trend you want to see. You want to see an upward trend. You want to see a growth in your rent. And so we're not just putting these numbers here. There's a thought process that goes into it. We're looking at certain things as we go through underwriting these deals. And so you have to kind of be cognizant of that. So we did say we're going to annualize it for all the months. For all the income rather. So if we look at the income column, then our income column comes all the way down here, right, to line 42. So what we would do is just simply extrapolate it. And you can just do that by grabbing the little box right there, and you can pull it all the way down. And that should just do it for you right there, right? So now that's the T3 that we'll be working with. So we make mention before that everything that's on your on the T12, want to bring it across to your SDA. So this line item is your gross potential rent line item, and we have there 3,125,248. So simply you just bring it over there, the 3,125,248, and you input that data there. Simple as that, right? So you pretty much go through and you do the same thing for the other columns. You just have to know what goes where, right? Like this, for example, is a month-to-month in terms of income, right? And so we have 14,808. So what column does that go to? Well, you'll get used to it as you go along, but that's additional income that's coming into the property, right? So we want to make sure that would go into the additional income column, which we talked about earlier, right? So so that would be other income. And for now, you can just put, other income there. We're going to capture that. And here you have loss to lease, gain to lease, right? So a loss to lease is the difference between the market rent and the effective rent. The market rent is the rent that you can get for if somebody's walk into your property today. That is the rent that you could actually get for a unit at the property, right? Your effective rent is what you're actually getting for the property at this point. So somebody walk in willing to pay $1,200 for a 1-bedroom in your apartment complex, that is the market rent. If somebody's there currently paying $1,100 for that same type of unit, that's your effective rent. So the difference between the two would be $100. That would be your loss to lease. So if you have that rent at $1,200 as your market rent that somebody would walk in and pay for, and you're currently getting $1,400 for that unit, then you're getting $200 above the market rent, and that would be your gain to lease. Okay, so that's the difference there between gain to lease and loss to lease, right? Here we also have vacancy, right? Vacancy, that's physical vacancy. And so you have physical vacancy and you have economic vacancy. Physical vacancy is when a property is physically vacant and it can be get back into rent ready condition with just a standard turn, or you just doing the basic things. You're not doing anything heavy in there. It's just a standard turn. So if as far as the SDA goes, syndicated deal analyzer, it has a column for physical vacancy and would therefore capture this information there. And that is 258,796. Right. So here is a physical vacancy. And then here you get 258,796. That's where you would capture that. If you notice, we put a negative before of it because it's vacancy. And then right now at physical vacancy, we stand at about 8.2% vacant. We are getting close to time here, but I'm going to spend to kind of get through this a little bit speedier. I can always go back and rewatch this. So we capture for the physical vacancy, and what we want to do now is just capture next for the economic vacancy, right? So the loss to lease is one of those things that would be. I want to make sure you can see that on the screen. Minimize this a little bit. So your loss to lease is one of those that is your economic vacancy, and then everything else that falls from 14 through 18 is your economic vacancy as well, right? So your concession, your bad debt, all that will fall into your economic vacancy. Actually, we'll stop here at line 17, right? So after you do this a couple times, you will kind of know what category things kind of fall in. Just take practice. And so we'll capture this as one of your economic vacancies. And then, of course, we know that we're going to pick up from here down to 17, right? So this number here, which is 188,906, would capture us as our economic vacancy, okay? So we also have other income in here, and this would categorize as other income. This is termination lease fee, which is also another other income. And then we can take a look at these numbers down here, right? And all of these right here fall into the other income category, maybe except for, but this is where so things like these, what happened is that this is a resident utility bill back. The property has maybe common water system there. They have somebody who is coming out and reading those meters, and they're billing that back to the tenant. So the seller is probably paying for the water, and then they're billing that back to the tenant. Late fee, of course, is additional income that comes in. Administrative fees, so pet fees, people charge pet fee. Pet fee can be a big money maker. So this area here is where a lot of operators make some money, right? In terms of, you have the rent for the property that you have to pay. That's what you sign up for initially. But if you want covered parking for your Lamborghini or something like that, then you have to pay for it. And then that's how these apartment complexes make extra money in terms of, because what you're trying to do is boost up your net operating income. You want to make as much money on the property. Some people do storage, right? You also have cable, right? This is also look like a bill back where you're paying back for the cable that the property itself is offering to you, right? So if you go down into the expenses, you should see cable down here that as an expense, it's right here, that the owner is paying for the cable down here right now, right? And what they're doing, they're pretty much billing that back to the tenant up here in this category. So it's just another way of just making income for the property. So these are all other income. So and would leave out interest income. Why would we leave out interest income? Because this is a non-operating expense. This is just like money in the bank that's gaining interest, right? So you wouldn't capture that because that doesn't have to do with the day-to-day operation of the property in terms of income. So you'll kind of get used to which one to include and which one to exclude, but it's important that you kind of learn these as you go so that you can make a proper evaluation of the asset that you're trying to invest in. So in terms of other income, we're going to capture this one, we'll capture this one, and then we'll capture from here all the way down here, right? And that looked like it's going to be 398,860. So if you have any questions, just I'll open up here soon. You can definitely ask those questions, and we'll make sure to address those questions. And so what we want to do here is just to make sure that our numbers check out. So let me just increase this a little bit more so we can see the numbers that we're working with. So at the bottom, after you analyze it, then you want to make sure that your numbers check out, right? So here we have in 3,090,151. that's what we should get also in the syndicated deal analyzer, right? So that's pretty much what you should get here. But if you remember, so that's 3,076,406. The difference here would be this $13,000, right? So if we're supposed to put the 3,090,151, and we take away this one, the 13 we did not include in there, which is 13,745, would come to the same thing. So here in the T12 we have 3,076,406, and here we have 3,076,406. So those check out. That's exactly what you want to do, right? When you're underwriting these deals, you want to make sure that your income item on your T12 also check out with your income item that is on your SDA, right? So in this sense, we have completed, not sure how many units is this property. That you would find in the OM. I think it was 88 units. But you do the same thing for your expenses, right? So you just check out the income item. You do the same thing for your expense item. You'd come in here and pretty much go through this in a similar manner, right? So, we're at about 11:30 right now. So I'm just going to take a few minutes just to go through this, and so that we probably can get these inputted in there. The whole essence today was just to show you how to, analyze these things and just to make the transfer from your T12 into your syndicated deal analyzer. On your T12 statement, we do not annualize the expenses. We talk about that before. We just use the expenses as they are. So there are different categories in here that you will want to go through and assign them to the SDA. And this one is very straightforward. One of the expenses in the SDA is the payroll. You can see these are management salaries, leasing salary, and everything like that. So all these will fall under payroll. I just like to highlight them and make sure I do my calculation myself, and just to verify that what is here is correct. So once I do that, I come down here and I check 327,855. Of course, is the same thing that they had here, which is confirming it, but I just like to make sure that I double check. So you'd grab that 327,855 and you just come to your payroll and you stick it in there. 327,855, I think it was, right? So you want to make sure that your numbers are correct, and because again, you want to check out at the end of the day, you want to make sure everything balances out. This is advertising, right? So we're advertising, and there we have brochures, we have marketing material that we're getting out. We're getting out information to the public about, hey, the availability of units over here for you to come and rent. And so you probably pay a locator fee. Maybe you pay a locator fee to someone who has located a tenant for you, but you got to pay for that. And the total cost there is $31,785. So it is that simple. It's a little bit time consuming, but once you do it a couple of times, then you can absolutely get in here and run through these in a half an hour. Here you check, this is all repairs and maintenance. This is 38,835. So if you think you're going to add something else to that column, or to that row rather, you can just put the equal sign before of it, so that when you come and add later, it just automatically adds for you, right? Here we have valet trash. That's another way of making money in a property, right? Valet trash, you have somebody who works at the property go to the door of those individuals who sign up for valet trash and actually grab their trash for them and take it to the dumpster. And so that's a service that many properties offer, especially A-class properties. And that's another way to add money to to increase the net operating income, right? So here we have two categories of trash. We have probably the valet trash, and we have garbage removal. So those will add together, which is 57,632. You capture that information there, and you just continue throughout just the same. Now, when you come down here, as you go through, there may be different categories that is put together. It's depend on who's doing the accounting, right? For example, and again, you want to make sure you try to categorize each one as accurately as you can, because what happens is that when you do that, you'll get a feel in terms of what things are going for per unit. If you click on this little plus button right here, then you'll see it's giving you the per unit cost. After you do this a couple of times, you will know or get an idea as to what number should be a good number for your per unit cost, right? For example, where we are in the Southeast, normally your repairs and maintenance and turnover line items together, those together should run about between $650 and maybe $700 in terms of that. So if you're doing it and you see those are running together like over $1,000, then it may be a way for you to increase operational efficiency, and it may be a good thing in terms of you being able to go in there, reduce the cost, and to improve operations and take advantage of that. Okay, so that's part of the reason why we try to categorize these as best as we can. Now we have some contract services, and we have some repairs and maintenance, and we have to kind of separate those. So contract service is more something that's recurring in terms of frequency and cost, right? For example, your main contract services may be like your landscaping, you may have your snow removal, you may have your trash and something like that. And so you want to make sure that you capture those into contract services and make sure you can account for those as well. So I did kind of go in here and just kind of look at it real quick earlier, and then I kind of categorize these. So, this would be contract services there, your extermination. I'll put this under repair and maintenance. And again, this is subjective, right? But typically you'll get a good idea after a while in terms of how to handle it. So what we'll do, we'll just come in here and grab the ones that are repair and maintenance in terms of pricing. We can grab this one, we can grab these two, and then we'll just add that to it, right? So here we're increasing that by 5504 for repair and maintenance. I think that was 5502. We'll just verify that. Actually, 5504. Let's just correct that. And then you have contract services in here. We can grab those. That's 34,971. Okay. And then you just have your G&A left over here, right? General administrative. And that is 3672. So we have gone through these lists here. Let's highlight that as well. We've captured that. We captured everything in there, I think. And you want to make sure you get everything, right? Because your accounting will be off if it's not. And, here you kind of look at what's here again, and you kind of categorize it the best way you see fit, right? Here, I already have that categorized as repair and maintenance, so I'll just keep that line item as repair and maintenance, which is 5893. And then these two, you can just add the contract service as well. And there you have 26,383. It's 26,383. Just verify that, right? And we're almost at the bottom of it right here. And here you just have, this is G&A. This is administrative costs, office supplies, postage and freight, just answering machine. These are things that helps to run the operations of the property. So anything that helps to run the operation of the property itself will fall under G&A. And in this case, all of these seems to fall under G&A. So we'll just capture it here. We just verify the numbers. That is 53,578. So we captured that. And then here, this is your management fee, right? This is a property management fee, right? So that has its own line item in the SDA. So we'll just capture that as it is, which is 78,554. Now, gas and electric and water and sewer are separated in the SDA. Here we have a combination of that, right? So you can see the electric here and the electric is here. So we'll capture those two on the gas and electric. So we'll capture that one. We'll also capture this one to be on the gas and electric, right? So those two are 25,138. And then these two right here would fall on the water sewer, right? So that number there is 147,336. And then there's a line item here. This is the services that the property has employed to get out there to read the meters for the tenants that are there, and then they are able to bill back the tenants for the gas and electric or the water and sewer, whatever they employ them to do. So this is actually a service that help to runs the operation of the property. So this would fall under G&A. So we'll drop that 8143 in G&A. I think it was 8143. We'll just verify that. Correct. And so now we've captured all the numbers in this little category right here. So the last few pieces that is left in this P12 has to do with taxes and insurance. You can see it right here, right? So we have the real estate taxes and we have the insurance. So really we can just capture all these taxes into one category. This is a Texas property, so it has a franchise tax there as well. But if we capture these three on the taxes, then we can just come back for the other one just for insurance. And that is 671,907. The number of units, I'm not quite sure. I just guessed it earlier to be 88. It's a pretty high number for your taxes, but if the number is different, then that will if the number of units is different, then that will change. And here we just grab the insurance, right? So the insurance is 120,640. So basically, that's kind of how you go through in terms of transferring data from your T12 over into your SDA or whatever underwriting model that you're using, right? You just go through it and capture it like that. And just like we did the income items, we also want to make sure the expense items check out. Right now, we have operating expense to be 1,637,833. So I want to make sure it checks out over here as well. And this is a replacement reserve, so we didn't have that in there. You can change that number over here. For properties that are built prior to 1990, you can use a $300 replacement reserve. This is a number that you can change, right? But if for properties for 1990 and later, then we'd probably use $250 for replacement reserve. You can see it once I change it, this number changes. But for now, we're just going to kind of take this number out of here. It will not be a part of our calculation. So this is the final number we're looking at, 1,637,826. And we have the same thing here, 1,637,833. A few dollars difference probably has to do with the rounding error, right? So that is how you transfer your information from your T12 into your SDA. You want to be able to do that. And once we do it a couple of times, if you were doing it by yourself, you probably got through this in probably 15, 20 minutes, right? But that will come in terms of, us doing it more frequently. So that's kind of the essence of what we want to cover here as a LP, as a GP, whomever. You should get the basics of underwriting. And we just want to kind of bring this to you in terms of transferring your data. Now, not all the time it will be as easy as this. This is a very straightforward one. Sometimes you get your T12 from your broker and they are in a PDF format. Sometimes you got to convert it into an Excel format, or you got to work with it in a different variety of ways. But of course, for the lesson here today, it'd be good for us to do something that is straightforward and simple. Sometimes you get it more complicated than that. And so, once we get into it, get out and reach out to your brokers in your area. Ask them to sign up on their site and sign up to get their deals, right? And when you get these deals, you'll get a T12 rent roll and OM. Start practicing this, and that way you can get a feel so that when you actually are looking into making an investment, you can actually ask the sponsors for the financials on the property. You kind of run through it as well. Now, of course, this is just the input of just the data. There's a lot more that goes into it. We have to come up here and kind of put in our purchase price, if we get a whisper price from the broker, but this is going to be a whole different thing. But so there are more analysis that needs to be done prior to getting your numbers. What you're actually working to get is to see, and of course, you got to find out what the cap rate is in the area. So there's more to be done here. Today's session is just for the input of the data, but ultimately you have different tabs down the bottom that you're also going to go and check in. And the bottom line is you want to have in mind what your targeted average annual return is, what your IRR you're looking for. For us at Cashflow Champs, we like to do deals where the IRR is 14% or better, and the average annual return is at least 15% or better. So if we underwrite a deal and it's significantly lower than that, and we don't see where we can improve that, we just move on to the next deal, right? So you want to know what your investors are looking for in that category, and so you kind of aim to, so you probably got to go through many deals, right, before you actually find one that kind of meet the return that you're looking for, and therefore you can bring it to your investors. So that's going to wrap it up here for today's session in terms of inputting data from the rent roll kind of into from inputting data from the T12 into the SDA and or an analyzer that you're using. And so I'll just open it up for a few questions. If anybody has a question or a comment that they kind of want to make based on what we covered here today.
Hi, I have a question.
Yes.
A couple questions. I saw the marketing package and my version projected. The management fee wasn't there.
This my version here.
Right. That's why the
so
numbers were different. So why there's no management fee?
Let's scroll on to management fee. So that's a great question, right? So what we normally use for so normally some of the numbers captures and go right across, some of them don't, right? The ones you can see here in the real estate taxes, for example, it captures and go across. So when we get the marketing package from the broker, this is the column that we focus on, right? Just the marketing package column. We don't normally use my version or the projected version. Typically, when we underwrite, we go right back to our pro forma. This is our pro forma in number 4 here. So if we're supposed to go deeper into this deal, so answer your question, some of the data do not transfer across over. But if I was gonna underwrite this deal, I would reach out to my property management company and find out what type of a management fee it is that they would charge me. Now, typically, like for example, we have the 236 unit we purchased earlier on this year in Atlanta, right? Something like that. We get in a 3.5% management fee. So I'll just come here and stick it in, and then I'll get the management fee that individual property management company is going to charge me. But to answer your question directly, the SDA sometimes does not transfer the data all the way, but in most cases it does. For example, when I put the insurance in here, it replicates all the way through. When I put everything in here, it replicates all the way through. For some reason, sometimes the management fee does not do that, but that's because it also gives us the opportunity. So if I was supposed to put it here, okay, you can see it's 106 right here, right now in my pro forma package. If I put it here into my version, for example, I put 4%. Say, for example, they're going to charge me 4%. Then you see, typically it replicate, for the other ones. This one did not change because I hard coded it in there just now, right?
So what do you go by? Just the marketing package price? You don't even look at my version or projected? I thought it was all about what you're projecting for upcoming years.
Well, different people underwrite differently. There are actually 8 different sections in here. If you come in here, you open it up, you can get some more too, right? You can get scenario A, B, C. So you can spend as much time on this as you want. You can go from 1 all the way through 8, right? What we have proven to be effective for us is that we don't need to go through all that. We just want to know what the broker is projecting in their marketing package, and we come to our pro forma and make our adjustment based on what we're gonna be operating the property at. Different people go through and they use my version and the projected version. It's to their liking, but we find out that if we just go to the pro forma, which is version 4, which carries through to your P&L, then is it going to be the same one in year 1? Then we're fine with that. But it's all a matter of preference.
Okay. And the other question I had was at the beginning, you said in the middle of, because I got in the middle of the webinar, you were talking about annualizing and taking the last 3 months. I think you were talking about the rent. So my question is, and I see that all the time, but why only 3 months, the last 3 months? What if, and we ignore the rest of the 8 months? You just look at the last 3 months, divide by 12 times 4.
Yeah,
Why
so that's a great question. But we do it for the income category, right? So
right, income, you said, yes.
Yeah, so for the income, we do it for the last 3 months, and the reason we do that is because we want to get the latest data as far as income. We want to see how the property is performing in the last quarter, right? So it gives an indication of what the property is doing. So, for example, for the whole year, your gross potential rent is $2,999,625, right? But for the last 3 months annualized, it's $3.125 million. So what is that is telling us is that the property is going in the right direction. We want to see that these numbers are increasing as far as gross potential rent. So it give an idea in terms of how the property is performing in the latter part of its history. Secondly, income items are more consistent than expense items, right? So you can do that for your income item and be fine. For your expense item, you couldn't do that because some expense items are paid like once or twice a year, for example, taxes and insurance. And if you miss those, that could skew your numbers a lot.
Okay, that makes sense. So income, so the last 3 months is more stable than the previous months, I guess, more consistent.
You get a good indication in terms of what's going on, in terms of how the property is performing now versus, I don't really care how the property was performing when the seller had it 9-10 months ago. I want to see how is the property doing now. For example, you may pick up a property and, you may have to do a value add to it. Now you get the property stabilized. So what the property was when I started doing the renovations and stuff like that, or when the seller was doing the renovation, is not as significant as what the property is doing now, when it is all leased up and ready to go.
Right. And I'm sorry, my last question is about the trash. So why there's 2 there are two charges, the valet and the removal. Isn't it supposed to be just one? So if you're supposed to charge people for valet, why do you have to charge them for removal trash? Because removal trash means, I mean, garbage removal means there's no valet, right? They have to do it themselves. Why did you add those two up to the expenses?
Yeah, because the trash category in the SDA, there's only one trash category, right? Is an expense. So I mean, this may be they have a trash company that comes in and grab those big dumpsters of trash and take it out. This is more one that has to do with, you know, somebody actually picking up the trash from the door
Got
of
it.
each
So
resident.
okay. So the garbage removal is mandatory. They have to pay for it anyway, and then the valet, they have an option.
Correct.
Okay.
That's correct. Yeah.
Thank you so much.
Oh, absolutely. Absolutely. Yeah, anybody else have a question? If not, we'll just thank you for your time. We ran a little bit longer than normal. I thought it would, because when you're dealing with numbers, kind of take a little bit longer sometime. But if anybody else have a question, you can say it now. Otherwise, I'll just kind of stop the sharing here, and
Just wait for the replay.
you'll definitely get that. Okay, definitely get that. Well, thank you guys. I appreciate your time. Thanks for your continued support of Cash Flow Champs. We really appreciate you. We have a deal out there right now still. If you want to be a part of it, you can be a part of it. It's in the Atlanta MSA, right outside of the airport. It's a 106 unit apartment complex, and the numbers on it are good numbers. And so if you want to be a part of that in terms of investing as well, it's a 506c offering, as in Charlie. So, you know, it can get it out to the general public. If you'd like to join us in that, just let me know, or just send an email to paul@cashflowchamps.com, and we'll get you some more information on it, where you can underwrite it yourself to it and see that the numbers make sense. So thanks again for your time. You have a great rest of the day. It's exactly 12 o'clock right now, and I will take the break at this point. Thanks again for your support. Have a great day.